This class is Derivative Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. Today we will go through Chapter 12, Trading Strategies Involving Options, from the excellent text, Options, Futures, and Other Derivatives by John C. Hall. The strategies we will consider include a bond plus option to create a principal protected note, a stock plus an option, two or more options of the same type, also known as a spread, and two or more options of different types, also known as a combination. A principal protected note allows an investor to take a risky position without risking any principal, sort of. An example would be a $1,000 instrument consisting of a 3-year zero coupon bond with principal of $1,000 and a 3-year at-the-money call option on a stock portfolio currently worth $1,000. So on the day of expiration of the call option, if it is in the money, the 3-year zero coupon bond will be used to buy the underlying stock. Of course, you can potentially still lose the money you invested in the call option itself. So the viability of this and whether it's profitable is going to depend on the level of dividends of the underlying stock, how interest rates change, volatility of the portfolio. The main thing is whether the stock goes up or not. If it goes up quite a bit, then you will outperform a money market fund. If it stays static, then you will underperform the money market fund. If it goes down, again, you will get the money back invested in the bond, but you will lose whatever you have invested in the call option. Variations on this product would include out-of-the-money strike price rather than at-the-money, caps on investor returns, where they say a maximum you can make, knockout areas, averaging features, etc. And this is basically the way a lot of annuity products are designed. But that topic is beyond the scope of this course. Option positions we will consider in this class will start with the combination of a stock position and an option position. The first one here, labeled A, is a long stock, and we're assuming we're trading around K, which will be the strike price of the underlying option. And you can see the underlying option here is a short call. So this would be a covered call position, and this would allow the investor to make a little extra money from selling the call premium if the market does not take off, and if the market goes down, it cuts down on their loss since they get to keep the call premium, basically selling insurance. But if the market does take off, they are forced to sell the stock, and it caps their profits. We can write this out by the combination over here of the profit for the stock itself is S minus K. That's this long portion here. Combined with right here is the short call. You get paid the call premium right here, but you are forced to pay out if the call is exercised, the maximum of the stock price minus the strike price, comma 0, and this would be the area of exercise. So if the stock price is less than the strike price, this is 0, and you have S minus K plus C. And that would be this payout range in red right here. If, on the other hand, S is greater than K up in this region, then this pays off, these two get canceled, and you just make the call premium right here. All right. The next position we will look at down here at the bottom, C, is also a long underlying stock, which is represented by S minus K. Now, on the other hand, we have a put option right here, and in this case, we are buying or going long a put, so you pay the put premium, and you get paid off a maximum of K minus S, comma 0. So a long stock and buying a put is commonly called portfolio insurance, and this is designed to minimize your loss. So if S is less than K, Then here we get K minus S, which cancels the S minus K, and we get minus P. So if S is less than K, all we lose is our insurance product, the cost of the put option, right here. On the other hand, if S is greater than K, then this goes to 0. We make S minus K minus P. We still make the profits on our stock going up, except we've paid for portfolio insurance, which isn't exercised, i.e. you don't wreck your car. But you still have to pay for car insurance. The next two positions we'll look at, labeled B and D, both involve shorting a stock and then another underlying option position. So B here, we have a short of the stock, plus we are buying a call. So the payoff from shorting a stock at K is K minus S. And here is the buying the call minus C plus maximum of S minus K, 0. In the region here, where S is less than K, if S is less than K, then this is 0. The intrinsic value of the option is 0. And we get minus C plus K minus S. This line here that gradually goes down. If, on the other hand, S is greater than K, we get S minus K here, cancels this, and we have just paid off our call option. So here you lose the money from the call option. Here you make the money from shorting the stock, but you don't make as much as if you just purely shorted the stock. On the other hand, shorting a stock is risky. You can lose an infinite amount of money. This prevents you from losing the infinite amount of money if your bet goes in the wrong direction. The final position down here, D, again, is short a stock, and now we again have an option position here. This option position is shorting a put. So the payoff from shorting the put is plus P minus K, our minus maximum of K minus S, 0. And then the short stock again is K minus S. So if S is less than K, if S is less than K, then this is K minus S, which cancels the plus K minus S. Since we have a negative here, and we're left with the positive put price, this red line right here. And if S is greater than K, if S is greater than K, then this is 0, and we end up with plus P plus K minus S. So we get a payoff here. If the stock goes down, we lose money. If the stock goes up, but we don't lose as much as if we hadn't, in this case, sold the underlying put option. Next, we will proceed to talk about bull spreads, which can be made using either calls or puts. A bull spread is a mechanism to make money if the stock goes up, but there's a cap on how much you can make. You do lose money if the stock goes down, but there's a cap on how much you lose. And it is manufactured by purchasing a call, in this case at a strike price K1, and selling another call, in this case at a strike price K2. So we have minus C1 plus maximum of S minus K1, 0 for the purchase of the first call, and then plus C2 minus maximum of S minus K2, 0 for the sale of the second call. If S, the stock price, is less than K1, then both of the calls expire worthless, and you end up with minus C1 plus C2, and that would be losing money right here. Purchasing a call with a strike price of K1 is going to cost more than selling. You will make by selling a call at K2, since a call gives you the right to buy, and the lower you get to buy at, the more expensive the call is. If we go into the region between K1 and K2, then we will have S greater than K1, so this is S minus K1, but this portion is still 0, so we end up with minus C1 plus C2 plus S minus K1. That would be the profit in this region, or loss down here, profit up there, and it's always good to check to make sure it is continuous. What happens when S equals K1? This goes away, and these two become equal. So our equation so far is good. How about for S greater than K2 in this region? Well, in that case, both of our options have an intrinsic value and payoff. So this is S minus K1, this is S minus K2. The plus S cancels with the minus S, and we end up here with a minus K1, and from here a negative and a negative K2 with a plus K2. So this is our maximum profit, and K2 is greater than K1. So it's up here. We can also construct a bull spread using puts. In this case, we will have a long put here with a strike price at K1 and a short put here with a strike price K2. So if we set up the profit, we get minus P1 plus maximum of K1 minus S comma 0 for our long put, plus P2 minus maximum of K2 minus S comma 0 for our short put. And we will again split up the payoffs, the profits from this, into the three different sections here, here, between K1 and K2, and here above K2. So in the region below K1, both of our puts will expire in the money. So we will get a K1 minus S, and here we will get a K2 minus S. So our profit for S less than K1 will be minus P1 plus P2. And then from here we get a plus K. From here we get a minus K2, so plus K1 minus K2. And our stock prices cancel out. A minus and a minus gives us a plus. Here we have a negative. So we end up with this equation here. K2 is larger than K1, so this is negative. It's a loss down here. How about in the region between K1 and K2? That would be this line here. Well, in that region, since S is greater than K1, our first option here, our long option, expires worthless. So the intrinsic value here is 0, and we're just left with everything else. So we end up with minus P1 plus P2. And then from here, we get a minus K2, and then a minus on the S gives us a plus S. And we can check here at our transition point. If S equals K1, then this equation turns into this equation. All right, how about greater than K2? If we're greater than K2, both of our options expire worthless, and we just end up with minus P1 plus P2. And we know that the value of P2 is greater than the value of P1 because you would prefer to be able to sell at K2. So P2 is greater than P1. This is a positive, and this is your maximum profit. And again, we can check at transitions. If S equals K2, then these two terms cancel out, and these two terms equal each other. So our transition point is valid. So those are our two bull spreads. How about bear spreads? Well, once again, you can create a bear spread using a call or a put. We will start with a bear spread using puts. And for a bear spread using puts, now we will reverse the order, and we will buy a put with a strike price K2, go long with that put. We will sell a put with a strike price K1, go short this put. So our profit is going to equal, well, we sold this one, so we get P1 minus maximum of K1 minus S comma 0. We bought at P2, so we get minus P2 plus maximum of K2 minus S comma 0. If we are in the region below K1, again, both of our puts will pay off, and now we will get positive P1 minus P2. Once again, we have a minus and a minus on the S, so this gives us a plus S. Here we have a minus S. Those cancel out, and now we end up with minus K1 plus K2. We know that K2 is greater than K1, so this is a positive, and that's our maximum profit. In the region between K1 and K2, then our first put here will expire worthless, so this will give us a 0, but the second put here will give us K2 minus S. So in that region down here, we have plus P1 minus P2 plus K2 minus S. Again, check at your transition point. If S equals K1, we stick a K1 here, and our second equation equals our first equation. How about in the region S greater than K2? Well, then both of our puts expire worthless, so both of our intrinsic values are 0. We end up with just plus P1 minus P2. We know P2 is greater than P1 and that this is a negative, so this is our maximum loss. And again, we can check at our transition point. If S equals K2, this is 0, and our second equation becomes our third equation. The last spread we will look at is a bear spread using calls. For this spread, we have a call option here, which we have shorted. So we short a call at K1, and we go long a call with a strike at K2. Our profit occasion is then C1, what we get paid here, minus maximum of S minus K1, comma 0, then minus C2 plus maximum of S minus K2, comma 0. Again, we will split this profit equation into 3 different sections. First, for the stock price less than the strike price K1. In that case, if S is less than both K1 and K2, both of our options expire worthless, and we're just left with plus C1 minus C2. A call option gives you a right to buy. You wish to buy at the lowest price possible, so C1, that gives you the right to buy at K1, is greater than C2, which gives you the right to buy at K2. So this is a positive, and that line is our maximum profit. How about in the range between K1 and K2? Well, if we are greater than K1, then this part, this intrinsic value is 0. The option C1 expires worthless, but the option C2 expires with a value of S minus K2. So we end up with an equation of S minus K2. No, we do not. This is incorrect. We will start again. So the last spread we look at is bear spread using calls. We will construct this by selling or going short a call with a strike price K1, buying or going long a call with a strike price K2. So our profit equation will be profit equals C1 minus maximum of S minus K1, comma 0, and then minus C2, maximum of S minus K2, comma 0. We will again split this equation into 3 different sections. For the stock price less than K1, for the stock price between K1 and K2, and for the stock price greater than K2. If the stock price is less than K1, both options expire worthless, both of the intrinsic values are 0, and we just end up with a profit of C1 minus C2. Call options give you the right to buy. You want to buy at the lowest price possible, so C1 that allows you to buy at K1 is higher than C2. This is a positive number, which is your maximum profit here. For the stock price between K1 and K2, well, if S is greater than K1, our first option here is in the money, and we end up with S minus K1, but our second option here is out of the money, so this goes to 0, and we end up with plus C1 minus C2 plus what we get right here, or minus what we get right here, which will be a minus S, and then a minus on a minus K1 plus K1. We will check at our transition point. If S equals K1, this goes away, and we end up with what we had for our first equation, plus C1 minus C2. How about in the region for S greater than K2? Then both options expire in the money. So we will get both of these, this one being S minus K1, this one being S minus K2. The stock prices again will cancel, a minus S and here a plus S. And we'll end up with plus C1 minus C2. From here we get a plus K1, and from here we get a minus K2. K2 is greater than K1, so this will be negative. This will be our maximum loss, and we should check out our transition point from the second equation when S equals K2. Well, that does give the third equation. So all of our profit equations are consistent. That was a bear spread using calls. A box spread can be constructed by a combination of a bull call spread and a bear put spread. If all of the options are European, a box spread is worth the present value of the difference between the strike prices minus, of course, the cost of purchasing the spread in the first place. This can be shown by the following equation. Here we have the profit, and our first equation here at the top is the bear put spread. Our equation here at the bottom is the bull call spread. If we examine this for all situations of the stock price being less than K1, of the stock price being between K1 and K2, and of the stock price being greater than K2, we will always get the difference between the cost of the put, the difference between the cost of the call, plus our payoff of K2 minus K1. Again, we can go through this in detail. If S is less than K1, this component right here pays off, this component here pays off, this component A box spread is a combination of a bull call spread and a bear put spread. If all options are European, a box spread is worth the present value of the difference between the strike prices on the day of expiration. If we look at the profit equation, of course, you have to subtract out the cost of purchasing it in the first place. We can show this by looking at the following equations. The one on the top is the bear put spread. The one on the bottom is the bull call spread. And we can examine this in all situations for the stock price less than K1, for the stock price between K1 and K2, and for the stock price greater than K2. If we start by looking for the stock price less than K1, then this component pays off, this component pays off. Both of these two are zero. We end up with our stocks canceling, and we have a positive K2 minus a K1 as shown here. If you go for S greater than K1 but less than K2, this component is zero. This component gives us K2 minus S. This component gives us the S minus K1. So our stocks cancel and we end up with K2 minus K1, and this component expires as zero. If we look at S greater than both K1 and K2, both of these components are zero, and we end up with S minus K1 minus an S minus K2. Again, the S's cancel out, and we end up with K2 minus K1. Since a box spread has a set payoff on the day of expiration, it is a risk-free investment in theory, and therefore should basically be arbitrageable like a zero coupon bond. In reality, of course, there are always complications with something like an option, and certainly if these are American options, it's not going to have a set payoff since there's the possibility of early expiration. We will stop here and continue with the rest of this chapter in a second lecture. I thank you for watching this video.